And here we go once again. Promises of a resolution to the conflict, an MOU that's going to be accepted, strait's going to be open, conflict's going to be over. The world is going to be wonderful. And where have we heard this before? Well, maybe just several months ago, repeatedly over and over. But the markets love it, right? We're seeing a rally across the board today. We are seeing oil below $80 a barrel, which is my personal threshold. I think the real estate market can be healthy with oil consistently below $80 a barrel. And what are we seeing on the 10-year Treasury? We're seeing it get down below that 4.7 range, but we're not seeing it rally like we have oil. And the reason being is because we got some ISM numbers today, and they were higher than forecast. Once again, just putting the pressure on that inflation is still sticky. And as we know from last week's Fed statement, that is their number one concern. They are not concerned about the labor market, although we're getting a ton of data this week from the labor market. They are concerned about inflation and the embedded inflation they believe is happening due to the elevation of energy prices due to the conflict. We're going to stay in this elevated range, in my opinion, until we can get inflation pulling back consistently. So what do I think is really going to drive the markets this week? Well, number one, obviously, is going to be this conflict. We've been promised, once again, we're going to get a resolution. The MOU is going to stick. Iran's going to capitulate to having a nuclear weapon and blah, blah, blah. So we will see if that happens. The second thing, and let me just hesitate and introduce myself. My name is Kevin Wiedmark, a.k.a. The Mortgage Mouth. Each and every day I come to you with what happened in the marketplace, how it affected interest rates, what do we got going out into the future, and should we float or lock? So the second thing that's going to drive the markets this week is going to be labor. And I know the Fed has stated they are not worried about the labor market. But should we get a non-farm payroll number that comes in way below forecast, so we show some kinks in the armor, you can be certain that the bond market will love that, because what it will do is it will table potentially future Fed rate increases, and that's really what everyone is concerned about. So should we float or lock? I would be floating. I wouldn't worry too much about the labor numbers that are coming. Fingers crossed, maybe they come in less. I think if we could sustain and get some real validation to the resolution of this conflict, I think interest rates can go lower. If I needed to lock, or if I'm shopping, I'm looking for seller concessions. I'm running an offer, at least I'm asking for them. And of course, I'm talking to my lender about the utilization of yield spread premium to cover my closing costs, create more affordability. And if your lender won't talk to you about it, this guy right here would love an opportunity to earn your business. All right, y'all, have a good evening. Coming to you tomorrow in another episode. Cheers.